Hi, I'm Suling Hui with part 1 of a video series about how your financials help you manage and drive business success. In this video, you'll learn how your accounts work as a three-way system. The term three-way accounts means profit and loss, balance sheet, and cash flow statement, all of which tie together. This is the only way you get a three-dimensional view of your business to get full insights into what's really happening with your business. That's why lenders and investors insist on seeing three-way accounts. As a business owner, you don't need to know how to do your accounts. Bean counting is the responsibility of your accountant or bookkeeper, but you as business owner must understand how to interpret your accounts, to understand what your numbers are telling you about your business. That's what I call bean reading, as distinct from bean counting. Your financials are your business health report. By understanding what your numbers are saying about your business or your proposed strategies, you'll know if you're on track to achieving your business goals or not. You'll be able to identify any issues in your business early on and fix them before they become major problems. And you'll be able to properly assess the appropriate strategies for business growth and your financing requirements. You also want to be sure that you are making decisions based on correct information, and this requires an understanding of the principles of how accounts are put together. You'll be surprised how many times I've seen accounts that are wrong. So let's look at how three-way accounts work. The reason you must have three-way accounts to get a complete picture of your business is because of the principle of double entry accounting. Double entry accounting has been the basis of business financial records for centuries. This principle is essentially the equivalent of Newton's third law of physics. Every action has an equal and opposite reaction. In accounting, this means every debit must have a credit and vice versa. That means every transaction that your business undertakes is reflected in two book entries, one debit, one credit. You can think of debits and credits as being the grammar rules of accounting language. The easiest way to understand how your accounts work is by using the old-fashioned T-account format. That's how accounts used to be shown in the olden days. Modern-day accounting, even accounting software, essentially work this way even though they aren't laid out in this format. A debit is simply the left-hand side of the T and a credit is the right-hand side. There's no rhyme or reason for this. It's just the naming convention that was laid out centuries ago. They could have called it cat and mouse. All you need to do is understand and accept that convention. This T-account format is very useful for nutting out problems. I still draw up T-accounts when I need to figure out issues in a set of financials. So, starting with the balance sheet, this financial statement shows you the financial position of your business at a point in time. It's a snapshot of your business at a specific point in time. The balance sheet shows you all the stuff owned by the business. That's assets on the left-hand side. And on the right-hand side, you see how the business funded these assets. The funding will be a combination of liabilities, other people's money, and equity, the business's own money. Assets on the left-hand side, that's the debit side. So, increases in assets is recorded by a debit to the relevant asset account. A decrease in assets is done by a credit entry to the asset account. Liabilities and equity are on the right-hand side. That's the credit side. So, any increases in liabilities and equity accounts are recorded by way of credit entries. Any decrease in liabilities and equity accounts are a debit to these accounts. As you can see, what happens with liabilities and equity on the right-hand side is the opposite of what happens with assets on the left-hand side. Your business's balance sheet is a sort of an ecosystem. It must always be in balance. Assets must always equal the sum of liabilities and equity. Every transaction that you do in your business, operational or trading activities, investments, or financing, will impact one part of your balance sheet, and there will always be an equal and opposite reaction that is recorded in your balance sheet so that the business ecosystem is always in balance. Let's look at how investment and financing activities impact your balance sheet. Say your business buys a van for $1,000. This van is added to your balance sheet by a debit to an asset account, which might be called van or plant and equipment or whatever you want to call these types of assets. This debit has to be matched by a credit to ensure that the balance sheet is balanced. What the credit is will depend on how you pay for the van. If you took out a loan from the bank to pay for this, then the matching credit entry will be an increase in the liabilities side of the balance sheet called bank loans or borrowings. On the other hand, your business might decide to use its own cash to pay for the van. In this case, the matching credit entry is a decrease in cash. Remember, a decrease in assets is recorded by a credit to the asset account. The cash flow statement will show at a glance that you invested in a van and how the business paid for it. There are strategic issues that need to be considered with investment and financing decisions. Issues such as whether taking on debt will weaken the balance sheet too much, what the implications for business profitability and cash flow will be, and so on. But right now, I'm going to leave it at showing you how these investments and financing decisions have an immediate impact on your balance sheet. Now let's look at how your trading or operating activities impact the balance sheet. The balance sheet is what your business looks like at a specific point in time, for example, at the 30th or the 31st day of the month. The profit and loss statement, however, is a record of all the transactions that you made in your business operations over a specific period of time. It could be 1 month, 3 months, a year, whatever. You could think of your profit and loss as a sort of a cash register. You ring up every income item and every expense item onto this cash register. Some sales or income items or expenses are received or paid in cash. Some will be in the form of IOUs. Every single transaction in your trading activities impacts your balance sheet. It's like consistently clearing out what's in the till and slotting the cash, IOUs, and payment dockets into the appropriate shelves on your balance sheet. The cash transactions increase or decrease the cash account in the balance sheet. The IOU or non-cash transactions go to increasing or decreasing various other assets and liabilities on the balance sheet, such as debtors, that's an asset, and creditors, that's a liability. But after all these transactions are slotted onto your balance sheet, the balance sheet will not be balanced unless, of course, you have zero profit. That means all your income and expenses net out to zero. With a profit, your income exceeds expenses. Your balance sheet gets back into balance by adding your profit to the equity account called retained earnings. Profits boost the equity base of your business and strengthens your business's financial position. The opposite happens with losses. Let's look at how this clearing of profit and loss transactions to the balance sheet works. The profit and loss is also a T account, just like the balance sheet. All income items are credit or right-hand side items, and expenses are debit or left-hand side items. So when you receive income, that is recorded as a credit to an income account in your profit and loss. Let's use sales as an example. You make sales of $100. Let's say $50 was on cash terms and $50 was on 30-day terms. So your sale results in an increase in two assets on your balance sheet, cash and debtors. As we saw earlier, increases in assets are reflected as debit entries on the balance sheet. So sales, which is a credit entry in your profit and loss, is matched by two debits on your balance sheet, a $50 increase in cash and a $50 increase in debtors. Now, let's say you pay wages of $20 and you pay it with cash. Wages are an expense item. It is a debit to the wages account in your profit and loss. The corresponding credit is a decrease in cash on your balance sheet. So after making sales of $100 and paying out wages of $20, you made a profit of $80. The profit number in the profit and loss account is the surplus of income over expenses. It gets cleared from the profit and loss till to the retained earnings account under the equity section of the balance sheet. The balance sheet is now balanced. Note that this is not a technical accounting explanation, but that's effectively what's happening. Just know that the net effect of your trading activities show up in the equity section of your balance sheet. So, your balance sheet will now reflect the fact that you made an $80 profit because the retained earnings under equity has increased by $80. This profit is represented by $30 in cash and $50 in debtors. It's obvious in this example that your profit of $80 only generated $30 in cash because we are only looking at two transactions. But how do you figure out how much cash your trading activities generated or used up when there are a multitude of trading transactions and a bunch of investment and financing activities that have happened during the period? That's where the cash flow statement comes in. The cash flow statement is your show me the money statement. It will show you at a glance all the cash flows relating to operating, investment, and financing activities. To recap, you need all three financial statements to get a full view of your business. These three financial statements must tie in with each other, otherwise you're not comparing apples with apples. The profit and loss shows you the performance of your business over a specified period of time. All your trading activities impact your business's financial position, your balance sheet. But profit doesn't necessarily translate to cash. The cash flow statement is where you find out how much cash your operating activities actually generated or used up. All investment and financing activities have an immediate impact on your balance sheet, and over time, the ramifications of these decisions feed into your profit and loss, which then feeds back into your financial position. Because the balance sheet is a snapshot of your business in time, you should have this statement for the start and the end of the review period, so you can see the changes that happened in your business position as a result of your operating, investment, and financing activities during that period. The cash flow statement is the show me the money statement. It pulls in numbers from the profit and loss and balance sheet and shows you the cash flow impact of every single business activity, whether it's trading, investment, or financing, over a period of time. It is vital that you have a very good understanding of the cash flow statement to ensure that your business survives and thrives. If you are bamboozled by this statement, as many people are, I recommend that you go through my 6-part video training series on the cash flow statement. Understanding your financial statements also enables you to properly harness the power of financial ratios or key performance indicators. These are derived by slicing and dicing the numbers from the 3 statements. Ratios provide critical insights into your business, insights that go way beyond what you get from the absolute numbers in your accounts, but they must be correctly interpreted. In this video, you've seen how your financial statements work together to give you insights into the 3 perspectives of your business health: performance, position, and cash flow. Part 2 of this video series on using your financials to manage and drive business success goes through a working example of how common business activities show up in your accounts. If you want more information about understanding your financials or about financing in general, please put your questions below in the comments or contact me through the contact page at incontextfinance.com. Master your cash flow, know your finances so that you can drive strong, sustainable business growth and thrive. Thank you for watching. If this has been useful, please like and subscribe to my channel.